the idea of risk, right? Risk of a single asset. And then we worked on a possible way to measure it. And so we said that if you look at forecasting at this time, and those are the prices of assets, of one asset, the best way to make a forecast, instead of using prices, is to actually use returns. So the return is defined as the current price minus the previous price plus the dividend if it's paid divided by the previous price. So it's the price change divided by the initial price. And if you calculate the returns from one period to the next over time, those returns can look like these. Or something like that. So the main difference between returns and prices is that prices are non-stationary, they tend to drift all over the place, but returns are actually contained within a more contained set. So forecasting those guys is easier than forecasting that. Now, the more those returns are spread out, then the more difficult it is to make a forecast. So we linked these to a distribution of returns. And we said that the more those returns jump, the wider this distribution is. And so the wider the distribution, the wider the volatility of returns, the higher the risk. The spread of the distribution is measured by standard deviation. And so we established that the higher the standard deviation, the higher the risk of the asset. Do you agree with that? To the point where if the returns were all identical, there would be only one outcome, and so the width of this distribution would be 0. So a risk-free asset has a standard deviation that is exactly equal to 0. There is no spread in values, it's just one possible outcome over and over again. Yep. So then we learn how to actually measure standard deviation from a sample, where if you have a sample of returns, your variance is going to be equal to the 1 over n minus 1 times the sum of each outcome, reduced by the average squared. That's your variance, and then your standard deviation is going to be the square root of that variance. So again, this applies to a sample of returns. Yep. So then last time we also learned how to do this with the financial calculator, where you use the data function to enter values, and then from there we learn how to basically have the calculator spit out the standard deviation. All right, so what we're going to do today is kind of a spin off of this. And we'll deal with portfolio of assets. So how to create a portfolio of assets, and then how to measure the risk of that portfolio. So first of all, the returns of a portfolio are the weighted average of the returns of the assets that you put in the portfolio, where the weight is defined as the amount of dollars invested in asset I divided by the total value of the portfolio. So that's the way you calculate the return of a portfolio. You need to know how well each asset has performed, but you also need to know how much it was invested in that particular asset. So one of the consequences of this is that the sum of the weights is always going to be equal 1. Okay, so the weights will always add up to 1, at least in this class. Questions? That's where we stopped, right? I think last time?
Yes.
Okay. So what I want you to figure out is, first I want to construct a portfolio of 2 risky assets. So two assets whose risk is known. And then I want to figure out how the risk varies as those 2 assets are combined. Okay? So consider those 2 assets. So this is asset X, the return of X. So this asset either takes a value of 10% or 0. And over time, this is the sequence of the returns of this asset. Okay? Now we have asset Y. Which is the same thing, but it performs well when the other asset performs poorly. So they're just kind of opposites of each other, those 2 assets. And what I want to figure out is what is the average return of X, what is the average return of Y, and what is the standard deviation of X, what is the standard deviation of Y. Now clearly you'll see that the averages are going to be the exact same because they have the same numbers. So use your calculator, put those as data in X. So those are all the values, X1, X2, X3, X4, and so forth. Don't do it for Y, you don't need to bother with that. Just leave Y blank in your calculator. And once you compute the average for one, the other one is going to be the exact same. So the way you do it is you go to what? To data first.
Mm-hmm.
And data is our number, I forget. Number 6?
7.
7.
Mm-hmm.
And so you need to have x1 equals to 10. Then go down. x2 is going to be 0. And you do all the way to x6, which is 0% again.
Mm-hmm.
Now, if you want, you can do both x and y. I mean, it's up to you. Actually, do both x and y. I think you should be able to get one more parameter from there. You got it? So after you enter all the data, you need to do the analysis of it, and you go to number 8, which is stat. No? Questions?
I'm not sure. So whenever I'm trying to put it in, I can't go past X.
Hold on. So okay, it's 4. So your X4 will be what? 0 again, right? 0. Press enter. So you need to make sure that you store it. And when you press enter, you see this triangle, meaning that this number is now in here. Now you have y4, and now gives you x5. But if you don't press enter, there is no, I mean, the variable hasn't been defined yet. It's empty, even though it shows you it's 0 for some reason. So after you go to stats, what do you see there? The first item is what parameter is estimating? The average?
The first one's when you go down one.
Oh, the first one tells you that if you want to do regression, is a linear regression. Just go down and ignore that, nobody cares. You're not doing regression.
And sample size.
So the first one is sample size and x, is that right?
It just says N.
N,
Yeah.
and is 6 in this case, sample size. You go down one more,
X bar.
x bar is the average of x,
5.
it's 5. And so this is our answer. Of course, the average of y is gonna be the same number. Now go down one more,
S of X.
s
S.
of x, is that right?
Yep.
So what is this?
5.48.
5.48, this represents what?
The standard deviation.
This is your standard deviation, right? So the calculator has performed this calculation for you. And then if you go down one more, what happens?
You get the population.
You get the population standard deviation, sigma x. We don't care about that, we always only care about this one. What else?
Now if you go down one more, you get Y bar.
And now it starts dealing with y. So your y bar should be again 5. Did you enter both values?
Yes.
Yeah, okay. So you have y bar, which is 5, sy, which is 5.48, and then sigma y, which we don't care about. And then go down one more.
Now you're getting to the linear regression piece.
It doesn't give you the covariance or correlation.
Gives me the.
What
Yeah,
is
it
the-
gives me -1, which should be.
So this is, what is the simple is?
It just says B though, which.
B, okay. Okay, so it gives you B next. And then there is something called R, which is -1. Keep in mind this for a second. Right, questions? So essentially we calculated the risk and standard deviation of those two assets. All right. So this parameter R is an assessment of the correlation between X and Y. So the correlation represents how one asset behaves relative to the other. And the value of correlation, so this is the sample correlation, the population correlation is this. So depending what you're reading, you will find it in either one form or the other. The one the calculator gives you is an estimation of this guy. This is the true one, this is the estimate. And what values can correlation take? Well, it ranges between -1 and +1. -1 means that those two variables move in opposite directions all the time. It's exactly what you have there. And a correlation of +1 means that they move in the same direction all the time. But correlation can also take intermediate values between those two extremes. So a correlation of 0 basically implies that those two assets are doing their own, each of them is doing its own thing, and they don't seem to be related at all. What I just said is not accurate statistically, but conceptually it's what it is. Okay? Now, what do we care about correlation? We're gonna see that in a second. Questions up to this point? So we are taking those two assets and we want to invest in both. So let's add to this problem and say, now, what is the risk? Of a portfolio composed of 40% X and 60% Y. So we're mixing those two assets together. So what is the formula for the return on portfolio? It is the weight of X, the return of X, weight of Y, return of Y, right? In this case, we only have two assets. What are the weights?
40 and 60.
I'm giving you the weights, they're 0.4 and 0.6. So this is the way we're gonna mix those two, those returns. Now the table of returns is this one, so let's assume that we are creating a portfolio and holding it, but keeping the weights constant over time. Okay, so we're always mixing them in with the same blend. So on this table, add one more column, if you can. This is the return of a portfolio, 0.6x, 0.4y. So the way you calculate that, those are the returns of x, the returns of y, apply those weights to it. So for day one, you have 0.4 times 10 plus 0.6 times 0, and you get 4%. Do you agree? I applied that calculation on day one. What about day two? Sorry, I flipped them. Oh. How about we do that? So 0.4 times 0 plus 0.6 times 10, and you get 6. Better? Yep. And I screwed up again.
You had it right the
I had
first
it right
time.
the first time. I had lasagna on Saturday, so this is the effect, I guess. It gave me massive amounts of cholesterol in my bloodstream. All right. So the weight of x is 0.4. The return of x is 10. Then the weight of x is 6.6 times 0.
And that's for day one.
That's day one, yes, the way it was originally. What about day two?
6%.
Hold on, step by step. It's 0.4 times 0 plus
0.6.
0.6 times 10,
Yes.
and finally we get 6, right? So repeat that over and over again every day for the entire set of 6 days. So you get 4 here, you get 6 here, 4, 6, 4, 6. Yep. They're good now? So what is the average return of the portfolio? What is the standard deviation of the portfolio? So just take one of the two, either x or y, in the data function in the calculator. Replace all the x's with 4 and 6's, or all the y's with 4 and 6's, and tell me what you get. So the average is going to be 5, right? Yep. And what about the standard deviation?
1.0 or it's 1.10.
1.1, do you agree? Yep. You good? So what happened?
The standard deviation decreased.
You can see that directly from the table. if you take each individual asset, the returns are jumping all over the place. They're bouncing back and forth from 0 and 10%. Now, clearly, I put these in a way that there is a pattern just for us to draw conclusions. The same thing happens if you invest in Y. But what about when you invest in a blend? The returns only bounce between 4 and 6, not from 0 to 10. So there is a smaller excursion of returns. And if there is a smaller spread, what can you tell me about the risk?
Is
The risk is relatively small. So this is something interesting. And if I were to plot the returns of X and Y over time, on day 1, you get 10. Day 2, you get 0. Then you get 10. Then you get 0. Then you get 10. Then you get 0. So those are the returns of X. There's quite a bit of a spread on those returns. And then you have the returns of Y. They're pretty much the same thing, but they start from 0 instead. That. But then if you trace the returns of the portfolio, you get a 4 and 6 alternating. Yep. So what do you think would happen if instead of picking those two assets, I pick one in place of Y that pretty much behaves the same way as X?
I would expect it not to affect standard deviation.
So let's suppose that Y was actually a copy of X. So it doesn't matter how you mix 10 and 10, doesn't matter what the weights are, you're still gonna get 10, right? Doesn't matter how you average 0 and a copy of it here, you still get it 0. So if those assets were actually copies of each other, meaning very, very similar to each other, the resulting portfolio would be just as bouncy, as variable as those two assets are. Yeah? So even though we are mixing pretty much the same assets, the way they behave relative to each other is what is responsible for what happens to the variability of the overall portfolio. So the first two assets that we picked, X and Y, we said they always behave in opposite directions. Well, their correlation is -1. Two assets that move in the same direction, the correlation is +1. If you were to calculate it, you would see that that's the case. And risk is not going to be reduced when you have a correlation of +1. So the risk of a portfolio or measured as standard deviation depends on how much you invest in the assets, depends on the risk of the individual assets, but also depends on the correlation between them. Depends on the weight of the assets, depends on the risk of the individual assets, and the correlation between each pair of assets. So that's how the formula for the standard deviation of a portfolio comes about. It has to reflect all those characteristics of the assets, not only how risky an individual asset is, but also how this asset behaves relative to the other assets contained in the portfolio. So that's a general idea. The actual formula for the risk of a portfolio with two assets is this. Let's call those assets X and Y. The standard deviation of a portfolio is equal to the weight of asset X, the risk of X squared, plus the weight of Y, the risk of Y squared, plus twice the weight of X, the risk of X, the weight of Y, the risk of Y, the correlation between X and Y. And then you take the square root. Obviously. Questions? So if you take portfolio management, you'll have to memorize this formula and you'll be using it basically daily. Make an effort to understand it for this course. This is going to be tested in exam 3, so you have time. But think about what happens when the correlation is exactly 1. If the correlation is exactly 1, this is a 1, and you're going to get some number, right? But what if the correlation is 0? So if this is 0, you're going to get the same number, except this part is missing. So risk is going to be less. What if correlation is a negative number? Then you're going to have the same values here, but now this part is going to be negative. You're taking risk away. And that's exactly what is happening here. This is the risk of one asset, this is the risk of the other. Those are the standard deviations of that. Right? The weights, they were given to you. And how is it possible that you take two assets with risk, but then when you mix them together, risk is actually this little? But this can only happen if some risk is being taken away, and if correlation is low.
Does it say PX1Y at the end of that?
Well done. Tell me when.
No, it's just
There.
This one, this is the row, the Greek letter row. This one, the same as this one. Which I'm not Greek, so I don't know how to write it properly. It's kind of like that.
Okay, is that a comma in between X and Y? Or a
Yes.
one? Okay.
Or sometimes I just write it X, Y without a comma, depends on notation. So this is how those two assets behave relative to each other.
Does it say X1Y?
Is X, comma, Y, or just X, Y? Kind of, does it make sense? So if you want to reduce risk as much as possible, what kind of assets would you look for? Assets with a correlation that is very high, or assets whose correlation is as low as possible?
Negative.
Well, you want to take risk away, so possibly you will look for assets whose correlations are negative. Ideally, if you really want to eliminate risk completely, meaning that those two guys behave completely opposite to each other, if you pick the right weights, you can eliminate risk completely. Like you end up with zero risk, you have a sure outcome. The weights that would allow you to do that in here are 50-50. If I invest half in one and half in the other, what is my portfolio return? 5%. What is the return here? 5%. So if I pick the right weights instead of 40-60, I would end up with a portfolio that always has the exact same payoff. So I'm mixing two assets who are risky individually, yet the combination of them has no risk whatsoever. I have a guaranteed payoff of 5%. Again, that can only happen if the correlation is exactly -1, and if I pick a specific set of weights so that the offsetting takes place. And takes place perfectly. Does it make sense? So let's apply this in a more generic way. If I want to reduce risk, where do you think I'm gonna be more successful? Across two different sectors or within the exact same sector?
Two different.
Why?
Different sectors.
Think about it. Same sector, what does it mean? What is more likely to be more similar? Ford and GM or Ford and Walmart?
Ford and GM.
Ford and GM, they do the same type of thing, right? So those tend to be more similar. If they are more similar, then their correlation tends to be what?
Higher.
Closer to 1. If they are less similar, then their correlation tends to be less than 1, right? So if you want to reduce risk, what should you do intuitively? Invest in few companies that do the same thing, or possibly a lot of companies that do a bunch of different things.
Across different sectors.
Different things, because different things means that the correlations between all the assets that you have are more likely to be low. Does it make sense? Yeah? Questions? So this is important to remember, finding assets whose returns have an absolute value of correlation close to 1 is very unlikely. What does it mean that assets whose absolute value of correlation is close to 1? What am I telling you?
Telling us that it's very unlikely for them to be super negatively or super positive.
It's very, very difficult to find two assets that behave the exact same, but it's also very difficult to find two assets that behave in opposite ways, right? So most likely you will find correlations that are, if you measure the correlations of all possible pairs of assets and you do an average, roughly you will get somewhere around 0.6 on average, the average correlation of randomly selected assets, pairs of assets, okay? So what does it mean? If the correlation is close to 0.6 or 0.5, well, it's good because it's not 1. Even with 0.5, you still get some benefit in reducing risk, yeah? So there is some value in reducing risk by investing in multiple assets. So you can do an experiment where you take, you create portfolios of different sizes, meaning with different number of holdings. And you select those holdings randomly, so you're not doing any research in how to add those assets. You just pick stocks at random, and you create portfolios with 2 stocks, and then you create portfolios with 3 stocks. If you take all the portfolios with 2 stocks, and you measure their risk, you will see that the portfolio with 2 holdings will have some level of risk on average. Now, if you repeat the experiment with groups of 3, so you make portfolios with 3 stocks, compute the risk of that portfolio, and repeat that for many other portfolios with 3 stocks, and then you do an average, the average risk of 3 stock portfolios is going to be less than the risk of 2 stock portfolios. And if you keep doing that for progressively larger and larger size portfolios, you will see that there is this pattern that develops. So what happens to risk as you keep adding assets to the portfolio? The risk tends to decrease as you keep adding assets to the portfolio. Why is that? Well, the more assets you put in the portfolio, the progressively less likely it is to find assets with high correlations. If the average is 0.5, as you're adding assets to that portfolio, you're getting closer and closer to an average of 0.5 correlation of assets within the portfolio. So risk is reduced. The problem is that risk is not totally eliminated. There is an amount of risk that persists even if you invest in a very, very large portfolio. Now, what is the largest portfolio you can possibly have?
Infinite amount.
Well, if you are within a certain market, like operating within the US, invest in every stock traded in the US. That would be a portfolio of the largest possible size in terms of holdings. Even that portfolio will still have some risk left over. Now, the risk that is left over takes a specific name, and we call it systematic risk. Systematic risk. So that is something, it's an amount of risk that is going to be dealt with if you want to be invested in equity in a given market. That cannot be eliminated. You're going to be stuck with it. What if my portfolio has this number of holdings? Well, then the risk of my portfolio is going to be most likely that much. Of that much, this portion is systematic, but then I'm going to have this extra amount that is linked to the fact that if I were to add more assets to the portfolio, this extra risk will be eliminated. So the amount of risk that can be eliminated is called diversifiable risk. Okay, diversifiable risk. Now, sometimes they call that non-systematic. And the systematic risk, sometimes they call it non-diversifiable. So depending when you read, you might have 4 different words describing those things. Questions? So what is the easiest way to reduce your risk exposure?
Invest in more stock.
Invest in a progressively larger and larger portfolio, larger in terms of holdings, right? So, do you think an industry can actually come about that facilitates this process? Think about what you studied in the early chapters in the semester. Mutual funds, right? The reason why they were created is to facilitate investments in large portfolios. As an investor, I know that ideally I need to have, say, 5,000 holdings so that I'm only exposed to systematic risk. But how can I get 5,000 stocks when I'm beginning to invest? I don't have the resources to do it, right? But if I invest in a mutual fund that in turn creates a giant portfolio with a bunch of stocks, I'm indirectly invested in an asset that has this type of risk exposure. Okay, that's why that industry came about. Questions? You good? How much of this stuff do you remember from Finance 3333? It's coming back somewhat? Yeah.
Except that equation, I'm pretty sure we did
This
not.
one, I think you can try it and see this. I don't know if anybody else teaches it, but I doubt it. It's kind of going beyond the purpose of that course.
I have a question about this hack board. When you were talking about putting in the 0.6x and the 0.4y percentages, do you put that in where you put the RX and the RY, or do you add a column or
To get this number,
to put it in?
so this is the way the calculation is carried over. And ultimately, the behavior of the portfolio, what we care about is just the return, so just the outcome of it. So the way you do it, you multiply each return by the weight of the asset. And so this one is gonna be multiplied by the weight of X, this one is gonna be multiplied by the weight of Y, and then for this day you add them up to get these.
Okay, do you put that in the calculator though at some point?
You have to do it step by step, just like we did it here. You have to do it manually.
Okay.
Then the standard deviation and those stuff, this comes directly from the calculator. But this we'll have to do manually.
Okay.
Yep. Is that what you were asking?
I was just asking if you had to put it in like you did with the 10 and the 0 with the,
Oh, to get those numbers right here?
yeah.
Yes, yeah, you would have to just replace one of either the X or the Y that you have in the calculator with those numbers. So make the X ones equal to these and you get those. Yeah. Questions? You good? So the next question is, well, what is investors' attitude towards risk? Do investors like risk or dislike risk?
Just like
Investors dislike risk, right?
risk averse.
So, since investors are risk averse, they'll try to avoid risk. You agree with that statement? And if they avoid risk, then what kind of holdings are they more likely to have? Just a few assets or a well-diversified portfolio? They want to have a well-diversified portfolio. Okay, so the implication of that they'll have diversified portfolios. So, if I'm holding a diversified portfolio and I want to add one asset to my diversified portfolio, the risk that matters is not the standard deviation of that asset. Because what matters is not only how risky that asset is, but also how that asset is going to interact with the assets that are already owned, isn't it? Because risk overall is composed of what? The risk of the securities individually, but also how those securities interact with each other. Does it make sense? So when you're dealing with investing in a portfolio of assets, you should be concerned mostly with how the asset you're adding to your portfolio interacts with the rest. The amount of risk that the particular asset has is relevant up to a certain point. What matters the most is how that asset interacts with the rest, okay? So they're motivated a different measure of risk. And given that the only risk that remains and cannot be eliminated is systematic risk, if you're dealing with portfolios, the relevant risk becomes systematic risk of an asset. So how can we measure the systematic risk of an asset? So, again, we're focusing on how the asset I want to add to my portfolio interacts with my portfolio. So one way to do it is, let's suppose those are the returns of asset X, and those are the returns of a broad portfolio. I collect the returns over time. And I make a plot. So those are the returns of the diversified portfolio. And those are the returns of asset X. So we are thinking about comparing the returns of this particular asset with the returns of this well-diversified portfolio, right? If it's well-diversified, it basically only has systematic risk. And so I'm gonna plot the returns of one asset against the returns of that diversified portfolio. This is 1%, 2%, 1, 2, and 3. This is day one. 3%, 2%. On day 2, this does 5. And this one produces a return of 3. I get this point. And then I keep collecting those points over and over again for some period of time. So you will see that there is going to be a bunch of scattered points in this graph. Well, if I were to feed a line to those points, the best feeding line, the slope of this thing can be interpreted as a measure of the systematic risk of X relative to the systematic risk of the portfolio. Right? Every time you're dealing with a slope, it's essentially a ratio between one displacement over the other. And we call this the beta. And it's a measure of systematic risk. It's the measure of systematic risk of asset X. And the implication is that it's relative to the systematic risk of the market. Oh, sorry, the systematic risk of the large portfolio. Okay. So let's see what numbers this beta can possibly take. Let's assume that, I'm going to throw it here again. Portfolio, and this is the asset X. Let's assume that the returns of X are constant. What does it mean? What is the risk of X? If it has always the exact same returns. It has no risk, right? If they are constant. If they're always 5%, 5%, 5%, that means there is no spread in returns. So if the returns of X are constant, the implication is that this thing has zero risk, zero standard deviation, and if you were to plot them in here, doesn't matter what the market does, these assets will always produce the exact same return, right? Because the returns of that asset are constant. So if you draw a line through it, this line will have a slope of. So the beta of the risk-free asset is going to be equal to 0. Do you agree with that? What about an asset that always does what that diversified portfolio does? So it just is an exact copy of it. But then you're going to get the dots arranged in a line that splits this graph at 45 degrees. So you're going to get something that looks like this. What is the slope?
1.
So the beta of a diversified portfolio is 1. Do you agree with that?
We're out of time.
Yep. So you can see a trend. The higher the systematic risk, continue the story, the higher the systematic risk, what happens to the beta?
Beta.
The higher the beta, right? So beta is a measure of systematic risk. It's not an absolute measure, it's a measure of systematic risk of an asset relative to the systematic risk of that diversified portfolio. Okay? Now this diversified portfolio in the literature is called the market portfolio. So many times you will see these labeled as RM, meaning that the market portfolio is the one that includes all the possible assets traded in the market. In real life, if you want to estimate the betas of assets, we don't know exactly what the market portfolio is. We just know it has a bunch of stuff in it. So we need to take a substitute for it, for a proxy, and normally we pick the S&P 500. Clearly, the S&P 500 is not at the very end of this graph. It only contains 400 assets, right? So it's somewhere here, but it's close enough. So out of convenience, we pick that asset instead of the unobservable market portfolio. And we assume they're the same. Questions? All right, so example. So what are the topics we are going to cover for this exam?
Valuation?
Is, hold on, in order. We did stock valuation, right?
Yep.
Stock.
Valuation difference.
And get a quiz on that. And lots of applications. Then what else? Then we talked about market efficiency. Is that right?
Efficient market.
Pleasure.
Then we talked about technical analysis,
Yes.
right? And behavioral finance. Yep. And then bonds. And for bonds, you had another quiz. Is that right?
Yes.
Okay, so as you go over the stocks, make sure that you know what preemptive rights are. Preemptive. So make sure that you have an idea what that means, and then focus on the actual valuation part. So dividend discount models. So how do we compute the value of a stock? How do we estimate it? Well, in general, is the value of the stock right now is the sum of the present value of all future dividends, right? How many of them do you have? You have an infinite amount of them. So clearly this is the starting point. But then we said, let's see if we can simplify this, and we simplified this to this, where the value of the stock at any point in time is equal to the next dividend divided by R minus G. But this only works in special cases. What are those special cases?
Gordon's growth model?
It's called Gordon's growth model, but only works if two conditions are satisfied. Condition one,
There is a G.
there is a G, meaning what? That all dividends
At a constant rate.
are related to each other and they go at a constant rate. And then this G must be what?
Less than R.
Less than R. If those two conditions are satisfied, then this monster becomes this easy thing. Yeah? So make sure you know how to describe the formula and of course then use it, but be ready to explain it. Make sure you know the assumptions, because I'm gonna ask you assumptions. Read the questions carefully. Constant growth is different than constant dividend. Did I say this right? What does it mean, constant dividend?
Means your dividend is the same value.
Means a dividend is the same. And that implies the G is equal to what?
0.
0. So constant dividend is a specific case, a specific example of a constant growth. Constant growth means that dividends are changing, but by the same percentage every period. That's why you get a value for G. Constant dividend means the dividends are all identical to each other, and the G actually takes a value of 0. Okay, so as you read the questions in the exam, if they are conceptual, read them very carefully and don't get confused.
What was the first condition? The G is less than R is the first, I mean.
The second condition is G less than R.
Yeah, the first one.
And the first one is that dividends grow at a constant rate. And the constant rate is what we call G. Constant rate of growth. Yeah? So, any problem in D2L on dividend discount model is fair game. So expect some of them will ask you to predict the dividend, some of them will ask you to calculate the value of the stock right now, maybe some of them will ask you to predict the value of the stock in 5 periods. And then the problems where you have mixed rates of growth. You have one period where on the right hand side where dividends follow Gordon's assumptions, and then another subset where dividends are kind of crazy. They're moving in an erratic way. And so the way you do this problem is by first calculating the value at this point in time using Gordon, and then you have to take the present value of each of those dividends, the present value of the stock,
Yeah, it's the same.
and then once you have the present value, you have a couple of examples in class, expect something like that in the test.
Do we need to know about EPS and PV?
Yes, so that is the price and earnings model, and you need to know that as well. So we can look at the notes, and it's actually easier than this. There is one model I will not ask you, it's the one where you have to estimate the rate of growth of the firm and has the ROA in it. So this is not gonna be in the exam. It's just an extra credit problem in D2L. If you wanna get the extra points, look at the book, there is an example that shows you how to do it step by step. But this is not gonna be on the test.
What about growing annuity?
Yes, growing annuity is also in the quiz, right? And so it's definitely the hardest type of problem that you have in the quiz. We developed the formula in class together. If you get a problem like that, is probably going to be one of the extra credits in the test. But still, it's kind of on the fair range because it was given to you beforehand.
Scantron
But
required?
Scantron required. But before you worry about that particular problem, make sure you know how to do the easy ones, because for sure you're gonna get those. And then only worry about the hardest type of problems.
Do you have an estimate of how many questions there are?
Hold on. Somewhere between 0 and 180. But maybe I'll narrow it down. All right, then we talked about market efficiency and technical analysis. Make sure you know what is the general idea of market efficiency. What are they concerned with when you study market efficiency? Well, it's how information is reflected in asset prices. Then we talked about 3 different levels of market efficiency, right? And what are they?
Weak, semi-strong.
Weak, semi-strong, and strong. The difference is in terms of what kind of information is reflected in asset prices. So let's suppose a market is not efficient at all. Would it pay off to look for patterns in asset prices?
Yes.
Yes, if you can find one, you can exploit it. But what about the market that is efficient in the weak form?
You can't use.
Well, historical information is reflected, so any pattern that you can identify is already somewhat priced. So using that kind of information is not likely to give you abnormal returns in the long run. It can work once, but that's about it. It's an anomaly. It's not something to be expected. Okay. What about a market that is efficient in the semi-strong form?
Don't expect public information to be used.
So it's consuming public information, and when is that information becomes public?
News or,
Is when it's released to the public, right? So a market that is efficient in the semi-strong form is one that reacts how to the release of news. If it's efficient in the semi-strong
it
form.
goes to the proper price, that's the proper intrinsic price.
So it's a market that reacts slowly or quickly?
Quickly.
Very quickly, right? So suppose Apple today releases the news that their next iPhone catches on fire when it's cloudy outside. Good news or bad news? Bad news. How do you think it's gonna affect Apple stock?
It's gonna go
Positively
down.
or negatively?
Negatively.
If the market is efficient, how quickly do you think it's gonna take for the stock price to
Not long.
drop?
As soon as it's announced.
Fast, right? I don't know exactly how. It can be hours, it can be minutes, it can be seconds. The definition kind of changes depending as we evolve. But definitely, would you expect that type of news to be source of profits in a month?
No.
No, it's already been priced by investors. Okay, so what about strong form efficiency? Are US markets efficient in the strong form?
No.
No,
Insider
why not?
trading.
It's insider trading.
There are some people that have access to non-public information, and if they use it to trade, they will make abnormally high returns. In fact, there is legislation that kind of aims to prevent that from happening, right?
That's never gonna get passed, isn't it?
Mhm.
Well, it's there, it's just, you know.
The legislation is there, proving that something is a crime is a different story.
Yeah.
So make sure you understand this in detail, because I will ask you quite a few questions on that. The technical analysis. What are the assumptions of technical analysis? So make sure you read that in the textbook. So I will ask you specifically this question: what are the assumptions of technical analysis? And there is basically 2 or 3 statements that you need to remember.
Are you gonna ask about like anomalies and like bubbles and things like that?
Yes, just a second.
Okay.
I skipped behavioral finance. So just know what it does. What are the main tools used by technical analysts? We talked about moving averages. And so you know in detail how a moving average is computed. We did it in class. And how a moving average varies if you increase more and more terms to the moving average. So make sure you are capable of explaining that. Then we talked about Bollinger Bands, right? Which is a moving average plus the standard deviations, plus and minus standard deviations. So make sure you understand how Bollinger Bands work and how they change if you add more terms to the series. And also think about how Bollinger Bands change when there is volatility. So remember, Bollinger Bands are the moving average. So this is a period of low volatility, and this is a period of high volatility. The moving average will kind of follow this stuff, but reacts at a lag. The Bollinger Bands put a confidence interval in a way around this moving average, but as volatility gets higher, this confidence interval gets also wider. So it gets, that band gets thicker, wider, bigger when there is high volatility, and it tends to be thinner when there is low volatility. So make sure you understand that. Then I will give you a problem. what I'll ask you to tell me how a bar chart works. The bar charts are the ones that have the prices and the bars. The highest point represents the highest price of the stock. This is the lowest price, open and closed. So make sure you read that in the textbook. Then we talked about instances where market efficiency seems to not apply. And so those are called, what's the name? You said it before? The anomalies. So make sure you know some of the anomalies. The important ones are basically the Jennings effect, the presence of bubbles in general, so know what a bubble is, and the PE effect, price earnings effect. And then the last topic was bonds, right? So for bonds, make sure you know what all the features are. I give you a list and make sure you memorize them. Make sure you understand who benefits from the features and how those features have an impact on bond prices. So if a feature is good for the investor, the price of the bond tends to be, of course, everything else the same. Good for the investor, the price tends to be higher, right?
Yes, yes.
So if the price of the bond is higher, what can you tell me about the yield of the bond?
It's lower.
Price and yields are inversely related, so it's gonna be lower. So if you understand that part, then everything follows logically. Then make sure you know how to compute the value of a bond. How do we compute the value of a bond? Explain it in words without symbols.
Present value.
Is the sum of what? The sum of
Present value of the
Plus
coupons.
par.
the present values of coupons and the present value of par, right? So this is what you're doing conceptually. Then there is a formula for it. If you know the concept, you can figure out the formula. Expect calculations on bond prices. And if you know how to calculate the bond price, then you can figure out what is the relationship between bond prices and interest rates. Just change the interest rate and what happens, and see what happens to bond price, make up a problem. So we did a graph that linked bond prices to yields. Make sure you know that graph better than the way you get home. And I will ask you several questions on that. If a question is about interest rates and bonds and prices, draw the graph. The question is gonna make more sense. Then we also arrived to another graph that specifically focused on the behavior of premium bonds and discount bonds over time if interest rates were held constant. So make sure you understand the graph. You might get some questions on that. Then we started talking about yields. So those are different ways to calculate the interest rate of a bond which are given the price. And we dealt with current yield, yield to maturity, yield to call, and realized yield, right? So expect one question each at a minimum. So make sure you know how to calculate them. The yield to maturity also has some definition attached to it, so make sure you memorize that definition and you're comfortable with it. Yes?
Well, you said there was two graphs, the premium and discount graph, and what was the other one?
So one is the relationship between bond prices and interest rates. And the other one is how bond prices change over time. How bond prices change over time if we hold interest rates constant. And that's where we differentiated between premium and discount bonds. Then of course, make sure you know how to do the calculations also for bonds and make annual payments and bonds and make some annual payments. You should be able to calculate things for both. And that's about it. Questions? You good? It's not gonna be too bad. Just make sure you do all the problems in D12. And I said that before. The way I calculate the yields in the problems in D12, my calculations can only be an approximation. I don't have access to the financial functions in D12. So if you're going to be off in your answers a little bit when you calculate